Everyone is talking about the Magnificent Seven. We see the headlines, we see those massive gains, but here's the thing, beyond all that hype, there's a really serious real-world challenge. How does a professional investor actually build a portfolio with these stocks without getting completely, wiped out? So let's dive right into that.
All right, we're going to tackle this as a kind of quest, broken down into 5 key parts. First, we'll lay out the big problem. Then, we'll watch 3 different analytical models just battle it out. After that, we uncover this really shocking anomaly. I can't wait to show you this one. Then, we'll reveal the winning portfolio, and finally, we'll face the nightmare scenario every single investor dreads.
So let's set the scene here. Imagine you're a portfolio manager, right? A client walks into your office, drops $10 million on the table, and says, "Get me into the Magnificent Seven." Sounds like a dream come true, yeah? But here's the catch. With all the institutional rules and just the sheer crazy volatility of these stocks, it's not a simple task. It's actually an incredibly complex puzzle. And this really is the fundamental question, isn't it? On one side, you have this potential for just astronomical, life-changing returns. But on the other, the risk of a catastrophic loss is very, very real. So the goal here isn't just about maximizing gains. It's about being able to survive the inevitable downturns. Okay, so here are the rules of the game for our $10 million fund. We're only looking at the Magnificent Seven stocks, and we're looking at them over the last decade. But the most important rule, and you really need to remember this one, is the regulatory limit. No single stock can be more than 30% of the total portfolio. This one constraint, believe me, is the key to everything that follows. So before we can even start thinking about optimizing, we immediately hit our first major hurdle. And it's not about which stock to pick. No, it's about the data itself. The historical data we're feeding into our models. See, past performance, especially extreme performance, can seriously mislead the entire analysis. Just take a look at NVIDIA, for example. Historically, it delivered an insane 66.95% annualized return. Now, if we just fed that raw number into our model, the model would act like a greedy algorithm. It would just try to pour all $10 million into that one stock. So to prevent that bias, the analysis made a really crucial decision. They capped NVIDIA's historical return at a much more, let's say, realistic 30%. This forces the optimizer to actually build a balanced portfolio instead of just blindly chasing a historical outlier. All right, so our data is cleaned up, it's tamed. Now it's time for the main event. We need to find the right weapon for the job. So what this analysis did was pit 3 different, very powerful portfolio optimization models against each other. It's like a battle royale to see which one could solve our puzzle most effectively. And our 3 contenders, well, they each have a totally different personality. On one side, you've got the Markowitz model. That's the cautious classic, always trying to find the lowest possible volatility. On the other end, you have the aggressive Monte Carlo simulation, which honestly just wants the highest return, period. And right in the middle, you have the arbitrage pricing theory, or APT. Think of this one as the detective, breaking down risk into things we can actually understand, like interest rates and market movements. And when we say the Monte Carlo model is an explorer, we are not kidding. This thing didn't just find one path, it generated and stress-tested 100,000. That's right, 100,000 different random portfolios, all while sticking to our 30% rule, just to find the single best one. So after this big battle of the models, who actually came out on top? Well, it's interesting. While the Monte Carlo simulation had the highest Sharpe ratio, that's a measure of risk-adjusted return, the recommended winner was actually the APT model. And you might be asking, why? Well, it all comes down to one word: transparency. See, the APT model didn't just hand us a portfolio. It told us why it was risking. It pointed to specific factors, like interest rate sensitivity. For a professional manager, knowing what your risks are is way more valuable than trying to squeeze out an extra fraction of a percent in returns. Okay, but this is where things get, well, they get really, really interesting. What the analysis uncovered next was something completely unexpected. In fact, I'd say it's the single most counterintuitive and important finding of this entire deep dive. Just think about this for a second. Should a really conservative investor and a really aggressive one, should they own the exact same portfolio? I mean, logically, you'd say no way, right? Someone who wants slow, steady growth should have a totally different portfolio from someone who's chasing crazy returns. That's the entire basis of financial planning. But in this specific case, the answer was not what you'd expect at all. And this slide just lays out the shocking result.
The analysis tested totally different investor profiles, from a conservative one targeting just 8% a year, all the way up to an aggressive one targeting 25%. And what did the model do? It gave every single one of them the exact same portfolio. I mean, the same stocks, the same weights, all resulting in the same 27% return. This is what's known as a corner solution.
So you have to be asking, why on earth did this happen? Well, this quote from the source material just sums it up perfectly. The portfolio structure is dominated by its constraints, not by the investor's return targets. Basically, those rules we set at the very beginning, that 30% cap on any single stock, and the fact that these tech giants are so highly correlated, they were so restrictive that they forced the model into the only optimal solution possible. There was literally no wiggle room. Okay, so now that we know how we got here and why the result is so unique, let's finally pull back the curtain and look at the actual portfolio that our winning APT model is recommending. And here it is. The optimal allocation is, wow, it's heavily concentrated in just 3 companies: NVIDIA, Apple, and Alphabet. Together, they make up over 75% of the entire portfolio. Microsoft comes in as a strong 4th, and then the other 3 Magnificent 7 stocks, well, they're just tiny little slivers taking up what's left. And each of these top holdings plays a really distinct strategic role. NVIDIA, obviously, is the pure play on the massive AI trend. Apple acts as a cash fortress. Its stability in that incredible ecosystem provide a nice balance to NVIDIA's higher risk. Then you have Alphabet, bringing in these dual growth engines with search and cloud. And finally, Microsoft serves as the defensive anchor, thanks to its super stable recurring enterprise revenue. But, what's in the portfolio is only half the story. What about the others? This is just as important. 2 of the most talked about stocks on the planet, Meta and Tesla, were almost completely ignored by the optimization model. So why would a data-driven approach just sideline such massive, popular companies? Well, the answer really just comes down to one thing: risk. For Meta, its history includes frankly, a terrifying 77% drawdown, which was the worst of the entire group. For Tesla, it's just that extreme, wild day-to-day volatility. The model basically looked at them and concluded that their company-specific risks, what we call idiosyncratic risks, were simply too high to justify a bigger spot in a professionally managed, risk-aware portfolio. So we've built what seems like an optimal portfolio. It looks great on paper. But our job isn't done. The final, and you could argue the most important step, is to stress test our creation against the worst possible outcomes. It's time to face the final dragon. And this is a truly scary number: negative 58.56%. This is the portfolio's conditional value at risk, or CVR. Just think of it as the answer to the question, if things go really, really bad, how much could I actually lose? And the answer is that in the worst 1% of years, this portfolio is expected to lose nearly 59% of its value. And just to be super clear about what that means, this isn't some theoretical number. CVR looks at what happens when that black swan event, that 1-in-100-year storm, actually hits the market. It's a measure of just how bad things can get when they really go wrong. And looking at past crises really reinforces this risk. During the COVID crash and that 2022 rate shock, this portfolio would have lost over 30%. But, and this is the big one, if we ever see a repeat of the 2000 tech bubble burst, the model estimates this exact portfolio could see losses somewhere between 60 and 75%. Just devastating. So the crucial point here is understanding why this happens. See, in normal times, these stocks have a correlation of about 0.54. They move together, but not perfectly. But during a real market panic, when the VIX, that fear gauge, spikes through the roof, that correlation skyrockets to over 0.82. And what that means is, in a crash, all these stocks fall together, hard. Your diversification, which is your main defense, it simply vanishes right when you need it the most. And all of this brings us to our final critical question. The analysis has built this powerful, high-return portfolio, and it's based on sound data. But given the extreme tail risk and the way diversification just disappears in a crisis, is it truly investable on its own? The data seems to suggest that while it's a phenomenal engine for growth, it absolutely requires active risk management and hedging, a safety net, if you will, to be deployed responsibly in the real world.